Treasury is under pressure. The 10-year back below 4.3% after Powell's speech, but municipal bond ETF ticker MUB seeing a bit of a pop. And joining me now with what a lower rate environment means for munis is John Miller, head of municipal credit at First Eagle Investments. John, it's great to have you here on set. Welcome.
Thank you very much. Thanks for having me.
So what does a possible rate cut in September mean?
Well, munis have lagged so far this year, and they've had to absorb a significant amount of new issue supply, record amounts of new issue supply, and demand's been a little tepid as people have been parked on the sidelines in cash or cash equivalents. If those cash rates start coming down, there could be more money put into the asset class. Really, it hasn't been any fundamental deterioration at all. It's been very much of a technically driven market. So more demand coming into the market in a lower rate environment should, I think, help performance overall.
It's interesting to hear you say that. I think there was a report out overnight that U.S. banks cut back muni exposure to lowest since financial crisis. And I was surprised by that because of your very point. The fundamentals aren't bad here.
Absolutely. I think really the linchpin of demand for municipals is the individual investors, particularly in the top couple of tax brackets. Maybe they've been restrained for various reasons in terms of just overall financial market volatility, uncertainty around inflation, and they are putting a little bit of money into work, but they're putting that money to work very short on the yield curve, but the issuance side is long on the yield curve. So therefore, each incremental year that you go out the curve, there's more yield available. And I think that bodes well after today for returns in the second half of this year.
What kind of yield are we talking about here?
Well, for high quality, longer term on the curve, you can achieve 5% or higher. And again, in a tax-free basis, the equivalent of that is around 7.5. Then for higher yielding is 6 to 7, and that's above 10% taxable equivalent.
I mean, we came into this Powell speech today, which, was definitely tilting more dovish. He definitely pivoted a little bit here. With stocks near record highs, with credit spreads tight, with other financial conditions really strong. And I just wonder what you think of what he delivered today and what it means more broadly looking across investments.
Sure. No, I think it was kind of a game changer today because, for one, there's a relief that he wasn't more hawkish. People were worried that he would, I think, push back on tariff implications. Of course, he mentioned the tariff implications, but kind of moderated the tone and thought that, or pointed out that he thinks that would be a one-off temporary impact. And he emphasized the potential weakness in the labor market, probably reacting to the fact that there were significant downward revisions in the prior employment report. So definitely a dovish tilt. And what that means, I think munis could be one of the bigger beneficiaries because they've lagged so much. As you've pointed out, equities, corporates, the Barclays aggregate, Treasury indices, they're all positive on the year. Munis a little bit negative on the year, but that means they are offering higher yields. So it could be a turning point.